Welcome to the WangHiro podcast, where we answer Malaysians' burning questions about personal finance with fact-based answers. BlackRock is the world's largest asset manager. They have 9.42 trillion US dollars under management. Its latest investment product, Spot Bitcoin ETF, could push this even higher. They've already received over $1 billion into Spot Bitcoin ETF within the first week. With strong developments like this, is it the right time to invest in BlackRock right now? Welcome back to Stock Investing from Zero with me, Louis, and my co-host, John. We give you a beginner's lens on global companies as well as local companies on this show. We help you decide if you should invest in a company by asking 4 questions. First, what do they do and how do they make money? Second, are they profitable and financially stable doing it? Third, who is their audience and how big can they grow? And finally, are they cheap or expensive? So John, let's start with the first question. What does BlackRock do?
BlackRock commands the world. No kidding. So I joke, right? If you talk about who owns the most assets around the world, actually BlackRock is the kind of like the undisputed king. Yeah, and
Outside of the secret families, right? Like Rothschilds and yeah.
Precisely. It's like the modern day Rothschilds. And when we come to the book recommendation later, I'll explain why also. So BlackRock is asset manager, financial software, research house, all roll into one. So if you think of the Bloombergs of this day, the Bloomberg will do, the professional terminals, trading terminals, and all that. BlackRock has something equivalent, which I'll share later, about risk management. But I think if you talk about, in essence, one sentence, what do? They're one of the largest asset managers in the world. Okay, now the 9.42 trillion under management. Share with you guys roughly how actually it was one decision in 2009 that propelled them to where they are today. It's just one decision,
okay.
And there was a very shrewd decision. So Merrill Lynch had an asset management arm. And what happened in 2009, because they bought equity stake in Lehman Brothers, which actually collapsed, they were actually looking to hive off that asset management arm because it was kind of profitable, but they felt that, desperate times call for desperate measures. They wanted to do that. But what happened was Capito, Larry Fink's right-hand man, actually went to see the second man in command at Merrill Lynch and offered instead of just buying the asset management arm, they offered to buy Merrill Lynch as a whole, almost the whole thing. So in the end, what happened was when the whole deal concluded, they bought over Merrill Lynch's asset management arm for about 13.5, everything in for about 13.5 billion. And from there, they grew their assets to where it is today. So kudos to, even, you see, you can buy a company, but you don't know how to grow it, also useless, right? But they bought it over, and overnight, they were one of the largest, because prior to this, you're talking about the guys like Vanguard. He's the pioneer of ETF, right? You're talking about State Street. So there's one chart, I think, world's largest asset manager. Largest asset. This chart shows it all. And the guys they started before BlackRock, all of a sudden were overtaken by BlackRock because of this, what they call it, this shrewd move by BlackRock.
Wow.
Sorry? It's called the $1 Trillion Club. I'll show it to you. Okay, wait. So it's here.
And they're again making history with the Spot Bitcoin ETF as well.
Yep. So yep. So it's quite crazy. So this was quite old. This is 2017. But as you can see, right, BlackRock is already 5.7 trillion way back in 2017. So the data that you got, the latest one, 9.42, the double of this already.
Within 5, 6, 7 years.
Correct. And can you imagine, they are larger than Norges Bank. Norges Bank is the world's largest sovereign wealth fund. That means they're the EPF equivalent of Norway, where they get a lot of oil money and they invest around the world, and they're larger than Norges Bank. So you just imagine how big they are. So it's like, I know some of these names may not be familiar. Amundi is also very big. Vanguard Group, State Street, Fidelity. Oh, you see, JP Morgan, the venerable JP Morgan, right? The asset management arm is like not even a quarter. Now, if it's, I don't know how much it is grown, but at this point, it's probably about a quarter of where they are, You see, 1/3 lah. Yeah, 6. This one, yeah, 1/3 lah. 1/3 where they are lah.
I'll be curious like how this chart changes as with all these and they're also pushing for Ethereum.
Yeah, yes. It's quite scary that you see that US commands like 11 guys on this spot. UK, France, Norway, Japan government. This is the government pension fund. Only then can fight. It can't even fight one company, So the entire pension fund of the Japanese government is 1.2 trillion. BlackRock is 6 times their size. You just imagine. Yeah, 6 times their size. So that's the joke I tell people. How powerful BlackRock is. It's like the Rothschilds of the modern day, right?
Yeah, so, I know. That's like also like the assets we can see.
Correct.
Right?
Correct. Yeah.
It's all the tentacles.
Yeah, all the tentacles that they have. So now, back to your first question about what do they do and how do they make money. Asset manager, they also sell software solutions. And let's look at the financials to see whether they're profitable or not. So a lot of their revenue comes from this management expense ratios of when we in our ETF compounders class, we actually teach about how to access each different kind of ETFs. And one component of the assessment is actually this thing called a MER, management expense ratio fees. So usually passive ETFs, passively managed ETFs, the fees are below 1%. It ranges anywhere between 0.01 all the way to about 0.7 or 0.9 for an active managed ETF. And this is makes up a chunk of their money, their revenue. Other than that, they also sell software subscription. There's one software subscription that manages risk for them. It's called Aladdin. Now, obviously, you can go and Google and look at other deep dives about it. Maybe I'll cover it in one of my stock dives one day. But looking at this, think of it is like Maybank Asset Management plus Maybank actually sells software. If I were to draw a parallel in Indonesia.
That's interesting.
Yeah, Maybank actually sells their risk management software to other people. That's their Aladdin software. It's very, very interesting, actually. I wouldn't go too deep into it. So next is, are they profitable, financially stable doing it? Yes, they are. I just plotted revenue. So we take net income. It's about 5 billion. Okay, 5.5 billion. Operating cash flow, about 5 billion as well. Okay, now 5 billion. I just want to draw contrast. 5 billion is probably Maybank's market cap is what? Hey, wait, this is 17 billion. Okay, Maybank's market cap is 100 billion Malaysian ringgit. So if we divide by 5, their revenue per year is roughly Maybank's market cap.
What?
Yeah. It's quite insane,
Yeah.
Obviously, this BlackRock's market cap right now. Let me see what's his.
I can't imagine if we extrapolate that at the other
Oh
time.
yeah.
50 years. Oh my gosh.
Market cap is 119 billion US dollars. Yeah. This is in millions. Yeah, correct. So 119 billion, right? So obviously they're profitable. Obviously they're financially stable, doing what they do. Who is the audience? This is the great question. This for me, their TAM is so easy. People like you and me, plus the banks, plus financial institutions. So you see, they got the everyday. They're like Disney, because Disney, you got Nickelodeon Junior, you got ESPN Sport, for the older guys, and then you got Marvel, right? You think of where their audience is, they have product for the everyday man, which is the ETFs. Okay, they don't have a bank, but they have a product for the everyday man that you can buy on exchange. At the same time, they sell their risk management software to financial institutions. So your Maybanks, your central banks are actually their customers as well, because they have an algorithm running to access, let's say, if you're an insurer and you want to underwrite a risk, underwrite a particular policy, right? You need that kind of software to be able to feed this kind of variables and then crunch out a number. Hey, is it too risky? What are the probabilities of this, that? So you see, that's where on the surface, we only know BlackRock based on iShares, but there's much more to it. They also do funds. They also do active fund management. They have an active fund management.
Mm.
Yeah, okay. They also do fixed income, your bonds, all that. Okay, virtually anything and everything lah. Put it this way lah. Yeah, it's quite
How
insane.
did it get started, right?
Yeah, how to get started? Like, let's just say if you look at it, if you were to compare, right? I think sooner or later they actually they do already some benchmarking, but they're not as big as the old guys are. You know, like the S&P 500s, the Russell. They have index, right? Wow, if they have their own index, like a
Wow,
BlackRock
that
index
is
or Morningstar
really
index, then you sell royalty fees and on top of that again.
oh,
You see,
wow.
so that's why you see today at S&P, right? You look at S&P, they were blamed for the financial crisis, but if you look at the share price, yeah, there was a dip 2008, 2009, boom, it still went back up. Why? You want to buy an IVV, you want to buy a QQQ. Who comes out in the index? Is these index companies. That's why they're promoting all this ESG and all these kind of things. Is because they are the guys that benefit the most.
No wonder. Oh, I've always wondered about the ESG
Why
thing.
ESG, right? Who comes out with the
Mm.
scoring mechanism?
Yeah.
You know, a HSBC guy was fired because he said ESG is BS, which I'm very aligned to him. I'm very, very aligned to him, but he lost his job because there's too many underlying hands, you know.
Mm.
Yeah. So thank
Yeah,
God
I
I don't work for HSBC
yeah,
and
correct.
Bank and whatsoever, right?
Speaking like against the company you work for, I
Yeah,
guess,
yes,
you shouldn't work for them.
correct. So again, I think that's where, okay, let's see, 1 year, 10% CAGR. If we look at, wow, so over 18 years, almost 1,000%, 13.3% over. Yeah, it's insane, right?
Yeah.
Yeah, slow and steady.
I
You
think
see,
most
Louis?
of us we
Slow
look at
and steady wins
their
the race.
products, but we don't look at the company behind it.
Precisely. So you know, when you were suggesting that we do this, I was like, okay, interesting. Louis has upped the game.
After
I've been
1 year.
studying BlackRock for quite some time. It's just that
Oh, okay.
I didn't go super. I went deep, but I didn't went super deep until valuation points are because it's too much to dig. Like just Aladdin alone, just to understand how much Aladdin's tentacles reach out. That's a question mark. Again, I haven't went that deep lah. Yeah. Okay. So last but not least, valuations, cheap or expensive, right?
800, right? USD.
No, not too bad. I think trailing PE of about okay, share price, you mean share price 800.
Yeah.
But valuations wise, I think it's quite reasonable, to be honest. 17 times
Oh.
for next 12 months. No, 20 times, sorry. Last 12 months, let me see. Diluted. Okay. 22 times. I think it's, to be honest, it's pretty reasonable. For a
Oh.
company the size of what they're doing,
Mhm.
I really think it's reasonable. Lah. Yeah. But that's for me. Lah. Okay. Historical, if you look at it, at the peak 2009, yeah, obviously 50 times. Now you're not gonna get tech-like valuations. You're talking about 60 times, 70 times of Nvidia right now. You're not gonna take that kind of tech-like valuations. These guys are, for me, their mode is really the entrenchment of their products and services in today. It's so prevalent, so ubiquitous that for you can't, you take it as if iShares was the creator of ETFs, which actually isn't the case. It's Vanguard's and the State Streets, you see. So because of their sheer size, their sheer frictionless experience to the investors, I think this is where it really shines. Yeah.
Okay, I think on the valuation and all these like hype around the spot ETFs, how do we evaluate that in tandem with whatever analysis that we've done now, right? So what if how do we know if it will be like a long term, like good move or bad move for BlackRock, right? These ETFs for Bitcoin and even Ethereum potentially.
I think they've been waiting for this ETF for many years, Louis. They've applied. I think if you followed the application, they've started applying it way back, even in 2016, 2017.
Okay.
Because Bitcoin was created 2008. And from that journey, when it started getting mainstream around 2014, 2015, 2016, a lot of these ideas, what we see today is a combination of many years of, trying to negotiate the regulators, trying to get it regulated. So this is really a combination of that many years of that one. If you ask me about what pushes share price, it's the same answer I'll give you about ETF, spot ETF prices. It's the same answer that I'll tell you about markets. It's just sometimes it's herd mentality, sometimes it's like irrational exuberance, sometimes markets go down also because of irrational words about the collapse, that kind of thing. So again, one way that there's a leading indicator is what we call fund flow. So fund flow means where is most of the assets being kept right now? As I mentioned to you earlier, 2023, 2022 was not a very good year for stocks. A lot of money has been kept in the sidelines, especially in fixed income. Why? Interest rates are high, ma. People always want to look for the best thing for their money. When you have very little risk because you're buying a bond or buying a money market instrument, your capital is guaranteed and you get a certain yield. So money will naturally move there, right? When interest rates go down, what happens? Your fixed deposit gets to a point where it's minuscule. You don't get meaningful interest, which can beat inflation. Then they start going into riskier assets. That's why during COVID time, you don't see, because interest rates are low, you don't see people rushing out to put fixed D. You see people rushing out to do what? To buy Rolex watches, to buy crypto. Because interest rates was low, money came a lot, stimulus money, okay, and people are being reckless. Now, I don't believe in the world it should continue. I believe in the world where there should be some sane amount of interest, which is like 2 to 3%, enough to pause and to force people to pause and think about the risk they're taking, right? And I think inflation is a good thing. Inflation as a whole pushes up wages, pushes up quality of living. Obviously, there is, some people argue there's a disparity, rich versus the poor. But for me, it's about growth and progress. Now, obviously, some people play the game better. That's why they're billionaires. Some people don't know how to play the game. That's why the social income status. But again, I think why all this is related is because if you understand the rules of the game, fund flow is one critical aspect that most investors, savvy investors, look at where money is going. What is the generation? There's one video I did way back, I think 2 years ago, Louis. I talk about generational money because the baby boomers are where the money is, right? And they are 80 and 90 years old, and they have it mainly stuck in hard assets. So real estate, commercial property, land. But the younger people, there's no connection to that unless you're brought up in a business family. So what do they see as frictionless assets? All these kind of new things, you see? So again, there's going to be a very big shift in where the fund is going to go. And I think that's where, if you're a savvy investor, you watch that.
Oh, that's a very, very useful insight. I think those who have captured that point, you can use it to your benefit for sure. All right, so I think that covers our analysis for BlackRock. It's something I picked just because we actually have a program around ETFs where we help newbies who don't know how to invest in ETFs learn to invest in ETFs, and BlackRock being one of the biggest issuers of ETFs, I thought, let's just take a look at how stable, how good this company is, right, John?
You didn't imagine it was a juggernaut, right?
Yeah, correct. So it's actually like even bigger, even like more diversified than I actually imagined. Okay, so let's move on to our final section, which is the investing book recommendation. So today, what's the book for today, John?
So since we're covering BlackRock, might as well talk about the guy who created BlackRock, right?
He's still the CEO, is it? Like Larry Fink?
Yeah. He's the current CEO, Larry Fink. Actually, Blackstone and BlackRock, they used to be tied together. Then Blackstone actually split. Blackstone is now the world's largest asset managers of real estate in the world today. Yeah, so Steven Schwartzman, you can go Google him. That's the guy leading Blackstone, the Blackstone Group. BlackRock, it's more equities, financial markets, and all that. So the guy running the show is this guy called Larry Fink. Okay, and there's actually many articles about him, but I think rather they call him the $10 trillion man. Can you imagine? Not
Wow.
even
But I mean,
billion,
it's
10
close
trillion.
to.
He
It's
doesn't.
close.
He's not worth 10 trillion, but the
Yeah.
asset he's managing is the 10 trillions, are right. So there's this book written by John Miller. It's called Larry Fink's BlackRock, and I think what the book actually really started off well was it asked this very, I would say, very cheeky question. I said, between Donald Trump, Vladimir Putin, Xi Jinping, and Larry Fink, who do you think is the most powerful?
Um.
And yeah, what do you think?
I mean, I would say Xi Jinping lah, but
Xi Jinping, right? Because he top-down approach, communist, very stronghold, right? But Larry Fink, on averages, commands 17% of all the global S&P 500 companies around the world. Not just S&P 500, which is in America. It's like you're talking about Fortune 500, around the world. And because of that in-depth understanding of businesses around the world, macro data. Can you imagine? You're the largest asset manager in the world, 9 trillion. You have risk management software plugged into the biggest guys in the world, financial institutions. You have all that data coming back to you and giving you that kind of insight. Okay. Not only that, if you are like maybe okay, like an Apple, okay, and let's just say the QQQ or an ETF that BlackRock owns so much of Apple, you actually get a board seat. Yeah, that's what you're qualified to do, because the moment you have more than 5%, you're a substantial shareholder, you can demand a board seat actually. So you can imagine BlackRock probably has like hundreds of, if not thousands of, their managers sitting on boards around these big companies. Can you
that's
imagine the kind of clout they have? This is what the book actually portrays. Money really buys power. Like
yeah.
what
I
you
think because most of the world is commanded by the capitalist market in the end. Yeah.
Yeah. So I think that's why this book actually painted also a sinister side to it. That's why you see the title, How BlackRock Loves Us, Watches US, and Destroys Us as well. Yeah, because they have the tentacles in almost everything, which I understand. There is a very blurry line right now between like, can BlackRock influence a lot of key decisions? I say they
Is
can.
it too big right now, right? Like how
Correct.
back in the days, the railroad companies had to be split up. And all that.
AT&T had to be spin off, and Standard Oil had to be split up into what we know today as Chevron, Exxon, ConocoPhillips. Too monopolistic.
Mm.
Yeah. So the struggle is this. The narrative after the subprime crisis in the US is that the bigger they are, the stronger they are, and it's better. They cannot avert the notion of too big to fail now, because you see how did the US or the global economy emerge from the 2008 global financial crisis? Was actually a merger of giants. You realize that or not?
True.
Yeah, it's a consolidation. Same for Malaysia. I mean, Malaysia, before we recorded the episode, remember I showed you that chart? I told you it took me months to get that kind of data. I don't know if you remember when that happened, 1997. I don't know how young were you then. A lot of banks were taken over. We had Hock Hua Bank, remember, in Sarawak?
Yeah.
So it was all taken over, all of these amalgamation, and we created the 3 super banks in Malaysia, the Maybank, the CIMB, and the Public Bank. Public Bank, if I'm not mistaken, Public Bank took over Hock Hua, if I'm not mistaken, right? Or was it Hong Leong? Either one. So I know Southern Bank was taken over by CIMB, and then, all this amalgamation happened. So now you get to a point where they become even more bigger, but the government's leave it status quo is because they fear another collapse. You see where I'm coming from? So it's a chicken and egg kind of scenario. You let them too big, you say, hey, don't overdo it, don't bully people. But at the same time, you cannot let them be small, is because even Singaporean banks, which are quite solvent at that point, they also amalgamated. They also did a lot of M&A. You see?
I mean, I think as everyday person, at least understand the giants.
Yes, at least know who are the giants,
Yeah, understand who are the giants, how they operate. At least there's some books written about this.
Yeah.
I'm very sure similar things are happening in Malaysia, but there's no book written about it.
Correct.
Yeah,
Precisely. Yeah.
So at least we with this book we get an insider view, a little bit of what's happening inside. And at least I feel we need to prepare ourselves in case we don't know, like what are their plans. They're so big, like $9 trillion company.
Yeah,
With
exactly.
so many, like with that information, I have so many seats in so many big companies. There's something gonna happen, I feel. All right.
Precisely.
Yeah. So that wraps up today's episode of Stock Investing from Zero. So hopefully our audience out there, you've enjoyed today's session. So what do you think about BlackRock? Are you an investor? Comment down below. And if you liked this episode, give it a like and make sure to subscribe and hit the notifications bell for more updates from WangHiro. Thank you again for tuning in today, and we hope to see you again in our next episode. Bye bye.